indeed. I appreciate tonight. I appreciate you sharing time. I appreciate your consistency. I thank God for all of you. I thank God for your enthusiasm. I thank God for your interest. I thank God for your desire to be empowered. I thank God for you making sure that your mic's on mute when I open up your mic for the members. Some of the members are on open mic because they're going to ask me some key questions to make sure that I stay on point. They are my backup singers. They're my background singers. They're going to help me. You know how important it is to have background singers. It's just not the same if you don't have Ethel Hayes behind you, keeping you on point, helping you get through, asking you questions. Yes,
Right.
indeed. Yes, indeed. You gotta have Henry Harden and Juan Johnson, like just keeping us on point.
All
So
right.
I need you all. I need you all. We need one another. And of course, I need my husband, Michael Robinson. Thank you for always being there for me. Even on Sunday mornings at 7 a.m. for Sunday as Sunrise, I'm still encouraging everyone. I promise you, if you get up at 7 a.m. on Sunday morning, you never know who you may meet. I met my husband at Sunday morning at like 7 a.m. or 9. And he said, "Why are you awake?" See? And I said, "Why are you awake?" And he said, "Well, I've been up all night." And I said, "Well, I'm up for work." He said, "I've been partying." Isn't that something? But God still
So
brought
did
us
you meet him on
together.
a dating website, JB? Was it a dating
Oh my
website
goodness.
or was
Oh
it just
no.
like was it online? How you know?
No, it was on this I can't even think of a name. I can't even make up a lie quick enough. No, it was just he was my Facebook friend and he inboxed
Oh.
me. Nothing exciting. Neither one of us was looking for anybody. We were just like he was just like, "Why you up?" I was like, "Why you up?" And then it went on from there. And here we are all these years later. And he said, "Well, I might check in with you later, but I gotta go to sleep." I was like, are you gonna participate at 7? He said, "No." At least he was honest. And then it was immediately love at first honesty. You want to turn me on? Be honest. It would have been worse if he had said, "Yeah." And then I looked for him, right? Then I'd be like, "Well, what happened?" So honesty is always the best policy with Afro
Yeah.
economics, indeed. But yeah, Sunday morning, he's been doing every Sunday morning ever since. So I am thankful. But I love the Wednesday nights that started the whole thing. No, we were doing Wednesday nights on Zoom before Zoom became really popular. They should give us a special discount. Look, Afro economics was always bringing it with Zoom, making sure that Rosita had a way to hang out with us.
Good evening, everyone.
Ah, good evening. And
Good evening.
Rosita is our featured member this Friday morning for the members only event. Rosita
Can't
is
wait.
bringing it, the health and encouragement. I picked I
Absolutely.
picked I picked her topic, so she didn't have any choice. I said, "You talk to us about why you're so healthy." She is a very healthy person. So she's gonna give us some health tips. That's gonna be great. I just want every member to to at some point just know, Miss Hayes, you're gonna be up. I want everybody to have a presentation, Mr. Johnson, in our members only, because instead of like, how everybody goes around the room and everybody tell their name and then by the end the meeting is over. No, I want us to just empower one another and get to know each other through truly from just spending time together. That is the best way to get to know another human being. Never has a business card created a relationship. You feel me? right, Miss Elliott? Like a business card does not make a client. Miss Elliott and I have been working together, for almost 20 years now. Maybe it
Yes,
is,
correct.
right? Right?
Yes, yes.
And you probably don't have the first business card that I gave you, but
Nope.
but you still have your relationship with me, and that's a blessing. I was
Yes.
I was telling a brother today, I was like, people really don't even use business cards, but you better have your website tight. He was like, yeah, I guess that's a good point. Remember, we used to do all that printed material and pamphlets and flyers and all this stuff. Now it's like, what's your .com? And then we talk. And so tonight, I have a whole lot of different websites where I pulled my information from, and I want to give them to you so that we'll have it also on this recording. Because when you're talking about stuff like this, someone may interpret it wrong. Say JB said, we're only talking about Biden's tax plan proposals and interpretations of it. I want to talk to you about, as a financial advisor, as the owner of a registered investment advisor, I focus on investments. I focus on how taxes impact my client. In addition to that was, I did a double major in school, so one of which was in accounting, but it doesn't really teach you a lot about taxes. Did you know that? An accounting degree does not focus on taxation. It's personal finance, time, effort, and focus that really teaches you about the impact of personal taxes on personal portfolios and things that impact people personally. But a lot of times people go, I'm an accountant. I know all that. Or you think my accountant will know all that. Well, no, a lot of accounting now is just data entry. So what we have to do is establish strategies so that by the time you do get to your tax preparer, they have it correct. You have it correct. It's really what we bring to them. Can you feel me on that, y'all? You know,
Yeah.
because if you
Yes.
wait until you do your tax return to address these things, it's not, it's too late.
So true. So true.
I don't want the woulda, coulda, shoulda. That's what I address. So sometimes I'll say, well, part of membership is that we do tax planning. And then the person will say, well, I've had my tax person for a long time. I don't prepare taxes. I'm not trying to change tax people, but I will tell you that I have found probably over $100,000 plus in errors on tax returns.
Mhm.
you know, people will, you should appreciate having someone that will just look at it for your best interests. Amazingly so. So it can only, empower you. I hear that a lot because we get caught in what we always do or who we're always, but I believe you, me, my purpose and goal in life is to make sure that I take your financial life to the next level. That you're not the same person that you were before you met me. I mean, I believe that I know I am that powerful. I have yet to meet a person who is not better off having met me. But you have to make that investment in yourself. You have to say, hey, I want to understand my taxes. Could you explain to me what this form is? But instead, we're too often just getting a tax form and signing it. We're too often listening to the news headline. The news headline says the Biden tax plan will only impact taxpayers who make $400,000 or more. Isn't that true?
Yeah.
I've heard it over and over, over and over, over and over. And I'm like, I'm sitting here reading over and over things that will impact my client. And only 1.8% of Americans or less actually make 400,000 or more. So they really wouldn't make the amount of money that they need to raise if it truly, really only impacted $400,000 in income or greater. I should make each of you repeat what I just said. Woo! But it's true. They have to raise trillions of dollars by adjusting these tax plans. But the marketing move is to say that the American Family Plan, all that they're going to do, $1.8 trillion, and they're going to replace all of that with just adjusting the taxes for people at 400,000 in income or greater. Don't believe the hype. So some sources of income or some sources of information are the taxfoundation.org, CNBC, the CNBC.com. It has articles on like, does Biden's tax plan affect those earning under 400,000? TheHill.com has an article, Biden's tax hike will hurt the little guy and kill some other opportunities. I don't want to get too political, but and then also, there's info, but I think that the taxfoundation.org is a good place to go as far as where things are heading. But what I'm doing is taking information that's out here and translating it for us, because I truly thought as well that it would really only impact people with 400,000 in income or greater. But then I started thinking about, no, these things could impact my clients, and the majority of my clients, like in the United States of America, the majority of them have taxable income below 400,000. So you're talking about less than 2% of the people have income that high. So let's some examples of it. Well, there's going to be a change, and I really want you to remember this, so I'm just going to come out with it on top. What really has not been talked about enough is that the personal business loss on your Schedule C, people that recognize a business on their personal tax return, will not be able to use that loss to reduce their income after last year.
Mhm.
I was blown away.
What?
Now say that again, JB.
Exactly.
You talking to me? You
Yeah, I
talking
know,
to
right?
me?
You talking to me too.
I know. If you do
Everybody.
if you do a Schedule C, this American Family Plan is going to make it permanent. Before this American Family Plan, it was actually going to be from 2021 to 2027. I mean, and there was no really public information about this. I had to dig deep about this because I have a lot of clients that I just encouraged to start taking their business expenses. And they said, oh my goodness, JB, I should have been doing this forever. All of this stuff, all these years that I've had this business and I've never recognized it. And well,
It's coming to
now,
an end.
it's going to be changed. That's going to be a change. So to say that it does not impact, or these changes don't impact people who make 400,000 or less, that is not true. There are a lot of people who of low to moderate income who do write off business income losses against their taxable income. So right now, if a person has a job, and then they also say have a small business, they do photography on weekends, and they also have a W-2. Right now, if their photography business loses money, they're able to reduce their taxable income by that business loss. No more. Now it will have to be considered a loss carry forward. So you can carry it to the next year, but most likely there'll be limitations on the amount that you could carry, that you could write off the next year against the income, or you would only be able to write off as much as income that you have. So if you have this big loss the first year, and you say you bought 50,000 of material for the business in the first year, and you have a even bigger loss of 60,000 this year, you're not going to be able to write off all of that. You're not, so be very conscious that we need to look into that deeper if you do a Schedule C. But what is interesting to me is that this is how systemically you are set up. You are set up for this because everybody was encouraged to set up these LLCs, which are pass-through organizations. So the LLC goes to your personal tax return, at which time the IRS said there's too much loss being flown through. And then remember, they said, well, you have to do it this way because you don't want to have the double taxation. And I would tell people, I don't believe that you always have to do it that way. It's okay to become incorporated, and do a separate tax return and do a C corporation, or so that you can have other investors in your business. But there's other ways, but they would always say, no, do the LLC and then pass it through. And people are doing S Corps going out the chain and it passes on through. Well, hey, that's how they got these figures. And they said too much too much loss is passing through. We're losing money here. So it's going, it's stopped. No, your losses, are not going to be, that was last year was the first year. The last year. And now you need to talk to me about when we do a review of your tax return. If you have a Schedule C on there, we need to do adjustments on how will that change your tax situation if you don't have your business to write off. And it might mean that you could consider changing your corporate entity even for some people. It'll take away for the little man a lot of the advantage of the sole proprietorship, because the sole proprietorship definitely has to be on the personal tax return. So if the person had their spouse was working, getting a W-2, and they had a business that had losses because of all that they were putting into the business, and then they were writing it off on that taxable, reducing that taxable income by the business losses, won't happen again. Those of you who it was relevant to, if you have any additional questions, we could continue to work on that. And I say this without being a tax preparer. So I'm saying this as a financial advisor, that is going to impact people with less than 400,000 in taxable income. So don't believe the hype that these changes don't impact you. And indeed that individual tax rate has been increased. But also some interesting things for us, like-kind exchanges. Has anybody ever heard of that?
Repeat that. Yes.
Like-kind exchange.
It's something about buying and selling your stock.
You so cute. No, it's used in real estate, but close.
Oh.
Exactly. That's so cute. She said, yeah, I was ready. We were all bracing ourselves for you to be right. I love it. It's called a Section 1031. A like-kind exchange allows a taxpayer to defer the recognition of gain on the exchange of real property, real estate, held for use in business or for investment. So people have been abusing it. That's why it's jacked up. That's why it's going away. It's over. Let's joke. It's not completely over, but they're not going to be able to defer their gains that are over $500,000. So people have been taking like $2 million buildings and not paying capital gains taxes on it and exchanging it for another building, and putting off taxes and putting off gains and putting off gains. And the IRS said, enough already. The maximum amount, it says the American Family Plan will end deferrals of gains of more than $500,000.
More than a
That's going to impact probably every real estate investor $500,000 is not a lot of money today.
Nope.
Right? So hard and say, nope, it's not, it's just not, especially when it's in real estate and they're trying to, defer it in an investment property by doing a 1031 exchange, the like kind, exchange. But wouldn't that be nice, Ms. Hayes, if you could do that with stock? I just want to, hey, they're similar. Let's just switch these two stocks. That would be really nice. Facebook, Amazon, let's just switch it. But that's what they've been doing with real estate properties. How unfair is that? If you switch Facebook for Amazon and you've made money, that's a taxable event.
Right.
But they're doing this with real estate properties. And now it's like, okay, but at least they're still giving you $500,000 that you can avoid paying taxes on. I know, Miss Davis, I know. And I'm talking to Bridget. Bridget is like,
I'm back here.
I know you were like,
trying to
Jamie,
figure
what does
something
this mean to me? I know you think you Donald Trump. Oh my
out.
goodness.
I know I do. I'm the black Donald Trump.
Exactly. Well, we really need to make sure that we give that to all, because our community does buy a lot of properties. Bridget owns a lot of properties. Like that's what she's into. So this is something I wanted to make sure that I brought out because the this yeah. And if it's cleared, like say they approve this now, they're retroactiving it back to March of this year.
Oh, okay. God. I was getting ready to say, please not last year.
Oh, I know. Wouldn't that be me? Exactly. Exactly. Getting all y'all. But if they get this year, they're going to make a lot of money because there's been a lot of real estate transactions. And the IRS is like, I want mine.
Well, JB, what's going to happen to with the people that paid more for the house?
Oh, these you mean that are paying too much, like the extra? Yeah. That's just, they don't get any benefit for that. You can't write that off. When you pay more than what an investment is worth, it just means that if you had to sell it tomorrow, you would have a loss. But as a personal residential real estate, you couldn't even write that loss off. So, the capital gains and losses, that's on investment property. Where Trump was doing the loss carry forwards, those are on, that's on business stuff.
Mm-hmm.
So check this out. This is an average person tax issue. We just aren't thinking about it. But under the existing tax law, the income tax basis of inherited assets or the fair market value of that asset at the time that the person dies and leaves it to you. So if your grandma leaves you a house worth $2 million and she bought it for $20,000 and you inherited it and it was worth $2 million, how much is taxable to you?
You get it
Zero.
at
Okay.
the
Oh, zero. Okay.
right.
Zero.
You get it at
Zero.
the inherited price.
Zero. That was called the step up in basis. But as a result of these changes,
Mm-hmm. Brace
this
yourself.
American family plan has a limit on that step up in basis. So the only step up you could get on grandma's property is $1 million or 2.5 million if you're married filing jointly. But you have to be conscious of that. If the single child who's not married and they inherit a property worth $2 million, they can run into taxes on $1 million of it.
Mm.
Do you know how many people, if they do not do tax planning, have a relationship, join Afroeconomics, and think about this stuff, they're gonna be jacked up. We're gonna be losing properties. This stuff could really impact the Black community big
Yeah.
time
Mm-hmm.
because the person would have to have, and then their income for that year would be considered $1 million. So then they would be over that 400,000. So I've seen some studies on do they need to factor in to this American family plan that sometimes people just have a windfall. They don't really make that much money. They just have a windfall. So if they have a windfall, they're going to be jacked up under this new plan. But that happens now. Like but it's a beautiful thing as far as like that right now a person you can inherit something from someone, or you can sell something that you have. And if your income is very low, your capital gains tax bracket, will be very low.
Mm-hmm.
But now they're stepping up the capital gains tax bracket on people who have higher income. So if you inherit something, it's going to make your income look higher and you're going to have to pay, that. So it's almost a way to try to encourage people to sell before they die.
Mm.
Or they're going to have like they're going to have insurance. And a lot of people, if they wait to do this type of plan, they're not going to have the insurance. Like say if we had life insurance can be used as a strategy to pay off taxes for this type of situation. And so if you have the life insurance policy, you would have to get it when you were older, because if not, it's going to be too expensive to use life insurance to do it. But you have to figure out a way like, okay, this value of this property is blah, blah, blah. Or you almost are like, but this is real. So we'll continue to look at that. And especially
Also,
to look.
JB,
Hmm?
It also impacts the Social Security if you're getting Social Security.
Especially like even like your Medicare premium kind of thing. Yeah.
No, it affects that, where that you will, if you made over a certain amount, the following year, they will give a surcharge to you that you have to make up that difference of the year before when you sold that house.
And on the even if the person is full retirement age, I wonder,
Right.
even if the person is full retirement age.
Yes.
A surcharge on the Social Security they made, or just on the Medicare?
The surcharge on the Social, you made more than the limited amount if you sold a piece of property. So
That's
now
crazy.
they go and look at
Oh, you know what it is?
Security.
You're right.
Yes.
It's that NI, what's it called? I saw that. It's that 3.8%. That's what you're referring to. I forgot what they call it, but you're right. You're right.
Yes,
You're right.
indeed.
That NI, well, I know you're right because it happened to you. but
You're
the
right.
exactly, but the
So they
I forgot what
reduced
they
my
call
social
it.
security
The
for a whole year.
net investment income tax. You know, and it can, if you're, and that is if your income, it's the amount of
You're over the
NIIT liability is 3.8% of the lesser of the amount of the modified adjusted gross income
Mhm.
or the net investment income. It's crazy, but yeah, it's real.
Yeah.
And so the so to think that it doesn't impact us, you know what I'm saying? That it's impossible for these things to impact people whose income is less than 400,000. It's ridiculous. One thing that was with that interesting is that with family owned businesses that have incorporated into it that um you will be able to pass on the business and avoid the capital gains if, like, because upon death of the business owner, that it has that same challenge as if you were inheriting a piece of real estate. You're inheriting a business and the business value. So if you keep the business in the family, they are proposing that they will have like a process that business owners, as long as it's owned by the family, can avoid the capital gains taxation on that. So, we got to, but we have to be there. That could, I mean, and that could easily, these changes could impact a regular person, a regular business, a business. A lot of times the biggest asset that we have as entrepreneurs is our business. So you're passing that on to your family, and then they're, going to lose everything up, or not lose, but have to pay taxes on everything over $1 million in value of the business. So at least that's under consideration to give business owners ways around it. But there also a thing that has been brought to the IRS, and we've talked about this in the members only meeting, that 1% of individual taxpayers report 20% of their income. And then that meaning that 1% of the people that are paying their taxes are only reporting 20%.
Wow.
So that's $175 billion, according to IRS reports, that they're not getting. So the Biden administration proposes providing the IRS with resources and information to get that money. The difference between the tax owed by taxpayers and the amount that you actually paid. So that American Family Plan calls for a significant boost in the funding of the IRS tax enforcement. They want $80 billion over the next 10 years to nearly double the agency's enforcement budget. They're coming after them. They might use that just to collect on PPP stuff. They're like, we can only go and get it. And they have all of this information now to go and get it. So there's, definitely these changes are going to have an impact on us a lot of times in ways that we don't really even realize. But one of the good things is that the unemployment benefits for 2021, I think there's going to be an extension confirmed about them not being taxable. So that's good, right?
That's a bone.
It's a bone, exactly. The taxpayers can claim a refundable 50% credit of up to $8,000 on child care expenses. for one child or dependent, or up to 16,000 on two children. So
but they
you
they're
know,
attacking. They coming after the middle class or the poor, protecting the super rich and throwing bones to the poverty stricken.
yep. And it's and what is the hardest part about it is what can impact us the most is so hidden from us that we don't get to see it. Like, we already have a wealth legacy challenge. And with this 1 million cap, it's going to be a challenge for our community as far as like what could be passed on without the change in the step up basis, because and it's the and that can affect everything. Like, that can affect, like, if you inherit stocks and they've had, your grandparents had a particular utility stock for 100 years, and then when you inherit it, you don't have a taxable event. You're inheriting it at today's market value, the day of death. So you can get, if it's 200,000 in that stock, current law, you can get all of that money. That's your new cost basis. If you sell it the next day and it's down slightly, you definitely are not going to have to pay any capital gain. That is your cost basis, the price that you inherited at. But that, you know what I mean? That would still be cool if it's 200,000. But what if her stock grew to 2 million or a million and a half? And I'm telling you, I have what you would see as an average person that are multimillionaires. So some of the people participating right now will have a challenge with this. Their children will. Their beneficiaries will. Like, so there has to be some, planning brought into this. I thought this was interesting. That currently it says carried interest is going to change. Carried interest is specifically for hedge fund managers. And they said that hedge fund managers have the right to share in partnership profits. Currently, it's taxable at the capital gains rate if certain conditions are satisfied. But the Biden administration would tax carried interest at ordinary tax rates. That's a good decision. I can't believe that all these years, these hedge fund managers have been paying just the capital gains tax rate, which is right now, the highest rate is only 20%. That's crazy. They could do that and leave everybody else alone. There needs to be some sort of like, this step up thing needs to have some sort of limits, like not to impact people whose estates don't exceed a certain amount of value. Because sometimes that's all the person has is a $2 million house. At the but I can see going after, income taxes that hedge fund managers are getting serious breaks on. They're almost saving like 20% by doing it at the capital gains rate. Imagine like saving 20% on your taxes. So the that also that net investment income tax, NIIT, that we were just, Ms. Walton, we were just talking about that. We need to look closer at that. And it just says this tax applies to net income to the extent that a taxpayer's modified adjusted income exceeds 200,000 for a single tax filer, or 150,000 for joint filers, or 125 for married filing separately. So if a person just has a windfall, they're going to have to pay 3.8% extra over but they're saying that nothing in this impacts anybody unless they make over 400,000 in income. No, right there. I mean, that could easily happen. Somebody, income, they sell something, and that's the only investment property they have, or and they go over, their modified adjusted gross income go over 200,000 one time. Never has ever for their whole life. You know what I'm saying? Like, it should at least say the last 2 years or something like that to show that it's a, you know what I mean? This is a high income person. But that one time, like, that's a hit, because it's taking away from someone when it's, you know what I mean? That's not their lifestyle. It's just that they sold something that particular time. So, but it's hard for things to be done and for it to be sold to you like it's not going to impact you. That's the hard part. That I'm thankful that somehow, God just said, let's talk about this, because I want these words, these discussions, to just stepped up in basis, carried interest, like kind exchanges. These need to be things that you've heard before, so that when you see it again, it's not the first time. And then the next time, because the more that we're exposed to, so when it is actually goes through, I can say, okay, these are the parts that really did happen. Okay, yes, we do need to look out for this capital gains change, for inheritance. Yes, we did. Yes, it did have a change in the step up basis. Like kind exchanges for those of you who have real estate. These are the confirmed differences. So this is our what they're proposing discussion, right? But when in a few months, once they hash this all out, we'll go over what actually we need to be looking out for. And that's going to be even more powerful. So there has been an increase in the top marginal tax rate. It's going right under 40% for those with 400,000 or higher. An interesting point is going to be trying to see when they say 400,000 or higher, are they saying for a single person with 400,000, or are they saying for married filing jointly for 400,000?
I think single.
What's y'all realize the difference, right?
Mm-hmm.
Because of two single people making 400,000, you know what I mean? That's 800,000.
Right.
So if it's saying married people, if they say single, then it will have most likely married will be like 800.
Mm-hmm.
To be consistent with the other stuff it has on the scale. It doesn't really, the tax code no longer really gives you a penalty for being married. But if it does the 400 and it's for married, then two single people making 400 or two single people making 300 will be encouraged to stay single. And that's something, you get that? Because they would be, if it's married and 400, you know what I mean? Then the two people together can't make over 400, or they'll go into that. Like, and there are actually people who look that deeply into it. Like, somebody's gonna call me one day. I know they are, and they're gonna be like, "Should we get married? This is what our income is." Blah blah blah. And I'm like, and you have to respect that, because that might be what they base it on. And then we happily ever after, you know what I mean? If taxes is the only thing that motivates them, they'll be single and happy, paying lower taxes. And that's something.
Mm-hmm.
And with the, there, unfortunately, it looks like, there's one thing though about the marriage. that married can pass on retirement assets, and married people, can have that joint with rights or survivorship. And so married people can pass on assets easier. It doesn't fall under the same guidelines as if it was a non-spousal beneficiary. Joint, if you have a property and it's joint with rights of survivorship, it is not a taxable event for that person to take it over. So that, if they're your spouse though, so you have to be careful. If you were joined with rights of survivorship and it's a non-spouse, you have to look at the tax guidelines on that. Most likely that is taxable. But so there's things these are things have nothing to do with income. They have to do with, just discovering about, if even if you went back and you saw it said, okay, married filing jointly 400,000 or more, they make this amount. Two people making over 200 is not that rare now. Two single people making over that, like it's really not. Next year this time it might be rare, but look, everybody's getting paid a lot right now. Doesn't it seem like it? Like, yes, indeed. That's indeed. And then remembering that the capital gains we're going to have to keep an eye on that any gains, paying taxes on inheritance over $1 million in capital gains. So we'll see. And and then we'd have to also consider, like, say it's a $2 million property, but the cost basis, you inherit a $2 million property, but the cost basis of the property was 800,000. It'll be, say, 1.5 million. You got it for 2 million. So your gain on it, if would not be taxable because the cost basis was 1.5 million. The problem is when it's something that they had a long time and time has passed and it does have a big gain on it. So they bought it for $20,000. And I've seen this. I have literally seen this. A client that had a property and it was in Massachusetts, and they got that property for like about $15,000 when they bought it from another family member and sold it for almost $2 million.
Wow.
So don't think like things don't happen. Things happen. So, but let's continue. So when we have our meetings, I want to make sure that that you take it seriously, putting your tax returns in the secure portal, that we continue to keep an eye on this, that you continue to ask me questions. Before you go, do you have any questions or anything those on the?
JB, this may sound like a dumb question, but how does everything you talked about, the word tax, first of all, is very scary to me, but secondly, how does this tie into estate tax?
Yeah, it doesn't seem to have any major changes on the, it's not noted at all that there's going to be a change on the estate tax rules on all of this stuff that I saw for this America plan. But what does impact the estate is that capital gains change. So that is going to be an estate tax issue, but that's an estate planning issue, but not an estate tax. Because I don't know, but I'm just going to throw this out here, about $10 million that you can inherit before the estate tax issue becomes an issue. And they haven't made a change on that. But what they've done specifically is to change that step up in basis upon inheriting. So see how they can break it apart.
Kevin, I'm going to clean the table when I get back. Oh, sorry, JB.
So you see how they can do an estate tax change without saying we're changing your estate tax inheritance, but it's a change to your estate issues without saying it's an estate tax change. A good question. But we'll have to, we'll just continue to look at it. But that step up in basis is definitely an estate planning issue, but not as there's a specific tax category called estate taxes. And that's for the amount that exceeds what you can actually pass on without having estate taxes on that amount. And it's quite a bit. But it's 5 million. So hopefully, and 5 million is not as much as it used to be.
No.
Yep. Especially, and it's good that you see that they pulled the business part out of it, because people, can have any kind of business that's worth more than $5 million. So they took the business part out and said, hey, you can have $100 million business as long as you keep it in the family. You don't have to worry about this, paying on that step up in basis. So that's good. Make America great. Long live the family. Family business. So that's one thing to encourage, like entrepreneurship. That's one of the few things that you can pass on, and the government still supports it. You're not really hiding it from taxes, but it's also a privately held asset, and they can't really tell what the true value is. So if you had to pay taxes on it, but once you sell it, like your company you have a family-owned business and it becomes public, or it gets bought out through a merger by another company, then what it's worth becomes real, and that can become a taxable event.
Trump did something like this with the real estate tax, and it hurt the blue northeastern states. What he did was with your federal tax, your state taxes would be deducted for that you wouldn't have to pay the full federal tax. And he capped it at $10,000 that only be deducted.
Yeah, on that itemizing. On the itemizing. And a lot of that was because they increased the standard deduction so much.
Right.
Yeah. But I've seen, more and more people now are really just taking the standard deduction, and the married filing jointly. And I think that a lot of people are doing married filing separately and not checking. Don't allow your tax preparer to say, we'll look at that next year. Don't do that. Say, let's look at it this year. Next year is what? That's a whole year away. We'll look at that next year. You got all my info. Let's look at it this year. If somebody's doing both returns, look at it both ways.
Well, why would they ask you to look at married filing separately, different in another year? Because that helps with student loan debt when you if you have student loan debt but your spouse doesn't, and then you would want to file married filing separately so they don't consider their income, right?
It was a lot easier for them to leave their income out. That's a good point, because I've seen that even with some seniors that still have loan debt, and then they want to get their payment lowered, and because they have their spouse on that on their return, and I've heard the loan company say that, but you really don't get a penalty. Now the standard deduction is half of the deduction of what you would get. So before, it would be like married filing separately was some sort of penalty. It's not really a penalty now. some people really need to do married filing separately, and that's a great example of it.
So isn't it that you be head of household file?
Ooh, now that's the best one. But if you're married, someone cannot really truly, if y'all are together, file head of household. So you have to blatantly lie and say we haven't been together. You know what I mean? In order to really get approved for head of household. Like, you know what I'm saying? The other person, the other person would have to say they're single, which now the IRS really doesn't care about that because single and married filing separately, the standard deduction is the same. No, so they were like, we're so tired of people lying. We're just giving the same deduction. if they want to lie, they can, but they're still, they're not getting an advantage, you know? There's no, but the married filing separately doesn't get a penalty anymore. So that's good. But like say you might have a house, only one of you gets to write it off. You know what I'm saying? You can't do it on both. But your question was about the head of household. Yeah. But if you actually are broken up, then you can answer all the questions regarding head of household, like we haven't been together, this person doesn't live here, blah, 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 because they're going to ask like, are you married? And they'll say yes, but, da, 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 da. Then it'll be, okay, you can be head of household. But head of household is great because your standard deduction is a lot higher than for a single person, but you can't be married and together and one of you file head of household. And believe you me, as someone who has been head of household, as a single parent, you ain't getting no advantages. You know what I'm saying? We are not. It is a reason that they give you that higher standard deduction.
Right.
You know what I'm saying? There's somebody out there is like, daggone. Isn't that good? They get to be that. Like, the only person that is the hardest one is it hurts the non-custodial parent. Because they're like, they get to write off everything. But generally, I know in like my situation, my child support for 15 years of her 18, till she was 18, but it didn't start till like she was 3 or 4. It was $125 a week. So that, like I don't know if y'all saw, I put up my podcast and I said, child support is not a financial plan. I really need to do a webinar on that. I was
that was a good podcast.
Oh, did you? Oh, thank you. Thank you. Yeah, that, we can make this work. That's why it can make this work. But like long time ago, I came out with babymamamoney.com. And I was like, I'm scared people are going to say something. You know what I'm saying? That I just held it again, like I did with Afroeconomics. So the lesson there is stop holding stuff. You're going to bless somebody by being bold. I got, there's so much. If you have some information like Ms. Walton was doing, you have information and it's going to help somebody, like, please share it.
Maybe you should go for your dream with the baby mama. It seems like a lot of
when I put her out there.
Women need that.
Yes.
A lot of women need that.
Oh, I finally did. I finally put it on the I put it on the podcast this week.
Oh,
yeah, I did it. That's right. Yes. And then last week I put it in a social media post. But it would be great to figure out how to develop a connection with head of households, men or women, who have that challenge of building wealth while you have so much responsibility. It is very difficult. And, being an entrepreneur, it was even extra challenging. But, it does, now, hey, she's in college and I lived. And that's to empower somebody, right?
Yep.
That's to help somebody. Right, Miss Spencer? How you doing? That's something. It's something to see people knowing you since you're in high school. Miss Spencer know me forever. Miss Spencer is one of the few people that know that this is my real hair. Tell them, Miss Spencer. I know people probably like, oh, that's not her hair. Tell them, Miss Spencer. You open up your microphone and you tell them the truth. Look, she's right over there hiding out. I'm not saying that. I'm a church lady. I got find. Look, I'm gonna find something. I'm gonna find somebody else. Somebody vouch for me. I know.
That's your real hair. You bought it.
Thank you.
Right.
That's baby mama's real hair. With her real, I gotta be a real husband. My life is real good. God is good. I appreciate you all so much. Thank you for your tenacity, your commitment, your good questions. This will be available on all of our social media platforms, definitely. So you can we can go, we're going to use this as our record book. We're going to see what gets approved by the administration and what doesn't. But when every time you listen to the news and they say 400,000 or more, say, okay, now let's look at the fine print. So that's all we did tonight. We looked at the fine print. Thank you.
All right. Thank you, JB.
Have a good night.
Okay, good night.
Good night, everyone.
Good night.
Good night.
See y'all soon. Bye-bye.